Hello and welcome to the latest quarterly investment performance video for Woodruff Financial Planning. This is just designed as a quick introduction to the past performance of our model portfolios that we use with all our clients and all new clients. Just to say, this data is to the 31st of December 2017 and we update this information on our website every 3 months. So let me just give you a brief introduction as to how we use our model portfolios. So these are a variety of risk-based investment plans that we use with all clients for new investments. So the idea is that you pick from the selection on offer the one that meets your needs. Of course, we can adjust them to individual circumstances depending on whether you need capital growth or income. But I think the idea of this information is that we can give you a good insight as to the differences between the different risk rated approaches that we take with our investments. So then when we come to annual reviews with clients, we review the ideal investments through the model with the actual investments that the clients hold. And the idea is that we can make minor adjustments as we go based on the research that we offer through this model approach. So I should say this is not guaranteed in any way. This is just designed as an indication of actual performance based on our past history with using these models. So bear in mind that your actual performance will vary based on a variety of different criteria, your own circumstances, the timing of your investments, the tax on your actual tax wrapper of the investment you go into, the charges that you make, and even other factors like the withdrawals that you make and when you make actual contributions to your investment. So there's a whole variety of reasons why this data won't prove to be correct for your situation, but really the most important thing is to think about how this can show you the difference in approach between a cautious through to an adventurous investment strategy. So here's the data. As I said, this is shown to the 31st of December 2017. We update it every 3 months, and this is how our model portfolio has performed over those periods. So you can see really differences between the different approaches. So if you look at the top row, you've got performance shown here over 1 year, 3 years and 5 years, both shown annualized and cumulatively. So annualized means taking that period and showing the annual return you would need to get to the cumulative return. So we look at the cautious investment here. If you go to the 5-year column towards the right hand side, if the cautious portfolio grew at 6.63%, these are all percentage terms by the way, 6.63% per year, that will grow over 5 years to be 37.87%. So you can pretty much see the differences between taking a cautious approach and an adventurous approach as we go down the list. So, over 5 years, the annualized return for moderately cautious was 8.49%. Remember, this is before charges, our investment charges and the charges of the product that you're invested through. The moderate portfolio generated 9.82% per year over 5 years. Moderate adventurous generated 10.98% per year over 5 years, and the adventurous portfolio generated 12.02% per year over 5 years. As you can see, there are differences at different stages of the cycle. So over 3 years and 1 year, the figures are quite different. I should say this data looks very good at the moment, and that's because we've been on a pretty good run in the stock market and with other investments. So I wouldn't expect that to last forever. And of course, these are all subject to change on a daily, monthly, weekly, annual basis. So just bear that in mind. So I think what you can do is you can look down this chart. You can pretty much take a view over any particular period that interests you, and you can start to see the differences in the expected returns based on the past performance. Of course, none of this is guaranteed, but the other important thing on this chart is to look at the FE risk score. FE is Financial Express, that's our data provider, and they produce a score which compares the individual investments to the FTSE 100. So that's the largest companies in the UK, the largest 100 companies in the UK, and on this scale, that index, the FTSE 100, comes out at 100. So in broad terms, this is not sort of particularly scientific, but in broad terms, the cautious portfolio is taking 44% of the risk of the FTSE 100, and the adventurous portfolio is taking 77% of the risk of the FTSE 100. So overall, you can see as we go down the list, the risk score increases, and it gives you an indication as to where these portfolios sit in relative risk terms. When we actually work with you as a client, we look at this in much greater detail at our initial and ongoing reviews. But really, this is just intended as a sort of a brief overview as to what you can expect. So if you took that information and this proved to be correct, which is all a big if, because none of this is guaranteed and this is already gone, but had you taken £300,000, invested it with our published advice charges and an assumed investment charge of about 1% per year, so that's for the funds and the investment wrapper, that's the return that you would have got for the 3 investment portfolios shown. So, take this with a pinch of salt because that's gone, but it does give you an indication that had you invested in our model portfolio 5 years ago, that's the return that you would have got based on £300,000 investment. So, a cautious investment would have grown by £72,000 and an adventurous portfolio might have grown by £179,000. I think what it does show is that investment does bring its rewards in positive periods like we've had. Of course, there are some risk warnings to mention. Of course, this is based on actual model performance, but there are no guarantees with any of this. And as I've said, the past is already gone. So your situation will be very different to this, and you can't rely on this in any way. We just want to give you an indication as to how these things work. And we have assumed charges in our returns, but of course your charges will be quite different, or will be subtly different to the charges that we've assumed. So bear in mind this is just an idea at this stage. It's not a definite information that you can rely on. Okay, thanks for your time.